Since 2015, there has been a 70% drop in the price of oil. It may seem odd that a commodity that is used nearly in everything can experience such a severe drop in price. Historically, drops of this magnitude have either been caused by a reduction in demand, typically caused by recessions, or a reduction in supply, such as the Arab oil embargo in 1974. For the past 50 years, OPEC has been what we call the swing producer of oil. In other words, they controlled such a large part of the market that they could largely manipulate the price of energy to suit their needs. These days appear to be over, since the U.S. has now assumed the role of swing producer due to the technological innovations of horizontal drilling and hydraulic fracturing of deep rock formations. Saudi Arabia has attempted to put the frackers out of business by driving the price of oil down to a level where it would be uneconomical for frackers to continue to drill. Unfortunately, this move has backfired on the Saudis, as they are now suffering very severe budget constraints due to the low level of oil prices. The technological innovation of the U.S. frackers will effectively put a ceiling on oil prices. Two of the largest fracking producers have indicated that when the price of crude reaches $40 to $45 a barrel, they will ramp up their drilling, thus putting more supply on the market and driving down the price. If all this plays out as expected, the recent rally in oil prices, up 28% from its February lows, but still off 5% for the year, will be short-lived. Since the price of oil and the stock market have been strongly correlated this year, it would seem that stocks may continue to return sub-trend performance. The demand side for energy looks to be weak, with the International Monetary Fund, the IMF, predicting slower global growth and Chinese exports falling by a record 20% over the past year. Continued slack demand with excess production is a recipe for continued low oil prices. If this scenario does not play out and oil prices rise, inflation will rekindle, forcing the Fed to raise rates. Any way you cut it, this is shaping up to be a most interesting year for investors, not to mention the uncertainty generated by the presidential candidates. I'm Tony Ogorek.